Okay, so today's Cardinal lesson, we're talking about a long-term care insurance policy that people with health conditions can get, serious health conditions. It's not everybody can get it, but a lot of people who thought they were uninsurable, they can get this. And Tom and I are like fired up about it. And we used to just have one of these. Now we got two, and we're talking about both of them. So Tom,
Yeah, I mean, we're doing this video because, like Hans mentioned, long-term care is very important to plan for, right? I mean, I can tell you countless stories of people who sit across my desk. They're taking care of a parent. I mean, you can just see it on their face, right? It's just draining. It's hard work. The parents haven't planned for it, so that falls to the kids, and they're sitting here saying, "I want to plan for this. I want to make sure my family doesn't have to go through this." And we start asking questions, and they have some health concern that prevents them from getting it historically. They couldn't qualify for anything. I'm in that same boat, right? I have health concerns. If you've watched the YouTube channel, you know I have an autoimmune disease. Most policies would not take me. I could not qualify for most of them. And so I get it. I see it in their face that it's just heartbreaking that they can't get something. Now we have options that will take people that historically had no options available. So it's a great thing. And we're, like Hans mentioned, we're really excited about it. Not for everybody, but if you're looking for it, if you want to plan for it, and you think you can't qualify, let's pause there because we might have some options available for you. So let me bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board where we'll get into the examples in a second. I'm not going to spend a lot of time in the show notes because you guys can look this up on your own. You can print them out, look them up online. But we have the two examples. This first one is company one, the insurance, the left example. These are the health questions they ask. We'll get into how the underwriting works with that one in a second. All the numbers that are on the board are supported here on the board. So go take a look at them if you want to learn more. And then company number two is the next company down below. Here are their health questions. And again, all the examples are related on the board. So I want to turn it back to Hans. I want to walk through the board. We might go back to the show notes, but really, if you want to learn more about them, you can go pull those up, look at them yourself. One thing I'll point out is both of those examples were for a 65-year-old female, I believe, or both were run at that. So again, just something to keep in mind. The numbers change slightly based off age. But you can get a general idea of how this works. So Hans, why don't we get us started? Let's talk about our options here.
okay. So go over like who's this stuff for? Starting with people with serious health conditions. We have some of them listed. People that maybe they don't even see them as so serious, but we have people that get turned down for the hybrid life long-term care policies or the traditional long-term care that end up, and sometimes it's a couple, one of them gets that, the other one doesn't. We put them in one of these. And, first they're upset about being turned down. They're thrilled to get this stuff. So the health conditions and the ability to insure a whole group of people that we didn't have something before is why we're so excited about it. The next thing I'm going to point out is I can make a case where these make sense financially. These are annuities, both of these. And, an annuity is the chassis that it's in. And, you put your money there, it's going to grow. It's going to grow slowly. You're not going to make as much in interest off of these as you could in some other kind of annuity or a CD or something else. So but these still make sense financially. The real reason that you're going to buy one is because of the fantastic long-term care benefit that's on here. So your purpose is not to get growth in the financial, although that's there. And probably the third place or the third group of people that are going to buy these is people that have an annuity already, and it's a non-qualified annuity. It's not an IRA annuity. It's just money that you've put in there like CD money, and it's been sitting there and it's been growing, probably not real fast. And so I use it as an example. Let's just say you had $60,000 that you put in there 10 years ago, and it's now $100,000. So you've got 100,000 sitting in an annuity. That annuity would be eligible to roll over into one of these and you wouldn't have to pay tax on that $40,000 of interest when you do the rollover or the 1035 exchange. And then it'll sit here and grow. And if you use it for long-term care, then, which is really the intention of these things, you're not going to pay tax on the money coming out of there. In other words, you could avoid the tax on that $40,000 of growth, plus any more growing that it does. So there's a lot of uses of these. I want to go quickly. I want to just explain, and I'll just push it to Tom, where maybe, Tom, you could talk a little bit about just positioning these.
Sure. Yeah, I mean, so one of the things to know with both of these products is it needs to be funded with non-qualified money, right? So you can't buy this with IRA money or 401k money. It needs to be money that's already been taxed. So that can be somewhat of a limitation. But at the end of the day, what you're doing is you're setting aside a chunk of money into this product, and both of them give you essentially 3 times that of money available for long-term care, right? So you're taking, in both examples, we used $100,000. You're turning it into essentially $300,000 initially, and then that number grows over time, available for care. One thing to know is all the benefits coming out of the long-term care policy are tax-free, right? So that's a big difference, where if you just kept the money, invested it, and you pulled it out, you're having to pay tax on that money coming out to pay for the care. All the benefits coming out of this for long-term care are tax-free, which is a real nice benefit there. But again, if you look at the example on the board, so let's go to the left side, right? You can see the amounts available at the different ages, right? So to give you some idea what these abbreviations mean, GCV is guaranteed cash value. So the one on the left side is an indexed annuity, meaning the growth is tied to some performance of the index. So guaranteed is the worst case scenario. They guarantee a 1% growth on the money as their guarantee amount. That's the worst it's going to be. PCV is projected cash value. So that's showing you some potential growth in the index, so it could be much higher. But then again, the reason we're buying it's not for the growth on that. That's not the main reason we're looking at it. What we're really looking at is that long-term care column and how that relates to the right side of the board, the monthly benefit. That's the real reason, if you're doing this, we're planning for, is we're really trying to get a monthly benefit that can be used to help cover that cost of care. So again, that's how to sort of read the numbers on the board there. At the end of the day, you're taking a chunk of money, you're getting some leverage from the insurance company, providing for the most, kind of the biggest risk that you face in retirement is needing some type of care. This is a wonderful way to do it, especially for people who have health concerns that are unable to qualify for other products. So Hans, why don't you get a little bit more detail?
Yeah. So, I don't show all these numbers to somebody. Like, we meet a lot of our clients on Zoom, and so I'm going to explain this thing with the hands in the air. And so both examples, you put $100,000 in. Most people that buy this don't roll it over from an annuity. They just take the money out of some other savings or a CD or something. So they put $100,000 in. You get $300,000 worth of benefits for long-term care. So, and it was just 100,000 in, and you instantly have $300,000 worth of benefits for long-term care. And so let's explain how that works. So I use an example of a guy that has Parkinson's, and he's sitting there, and the first thing he's thinking about, how are they going to give me any benefit for long-term care when I have been diagnosed with Parkinson's? I thought I couldn't get any insurance. You absolutely can. And so we're going to put the 100,000 in. You're going to instantly have $300,000 worth of benefits. And let's just say that very quickly you had to use assisted living, or you're going to get home health care, and you're going to meet all the qualifications. And let's go over to the policy on the right, because it's easier to explain. You put 100,000 in, you got $300,000 worth of benefits. They are immediately going to start paying you $4,164 a month for the long-term care benefit. That's an indemnity benefit. They're going to start sending you a check every month as long as you need long-term care. Where they're getting this money from is they're just sending you back your own money for the first 2 years. If you take 4,164 times 24, it equals $100,000. So the first 2 years, you're just getting your own money back. But after that, the 25th month and on, all the way up to the 72-month maximum, you're getting $41.64 a month from the insurance company, and you're not paying taxes on that. So that's how you're going to get. You'd have to be 72 months under care to get the whole 300,000, of which you've only paid $100,000 for. And I'm going to tell you how I know when people finally get this, because it's a little confusing. I'm throwing hands in the air. Is when they finally look at me, and the guy that I'm talking about in the example that has Parkinson's, when he looked at me and he says, how do they do that? How does the insurance company pay me that extra 200,000 when they already know I got Parkinson's? Well, first of all, they don't know you have Parkinson's because they never asked. And they observed that, if they did a video interview, you look fine. I'm observing you right now because this is early Parkinson's. People with these new medications can last a long time, where they look and act completely normal. And so, in any case, when he asked me, like, how do they do that? My answer to that is, well, I could tell you, it'd take me a while. But what I'm going to tell you is the insurance companies know how to take care of themselves. Let's not worry about them. They got themselves covered in this kind of thing. This is first and foremost a way for people with certain conditions, and there's a lot of them listed here, that can get 3 times their money for long-term care. And we have a lot of people purchasing this once they understand it. So what I want to give is, I just gave the example of him. Over here at the company on the left, this one's been around for about 3 years, okay? And we've sold a lot of it. This one has just come on the market in the last 3 months, and we've sold a few of these. This is in almost every state. It's not in New York, it's not in California, and it's not in Indiana. But it's everywhere else. We operate in all 50 states and DC, and we can sell this product anywhere but those 3 states. This one has a lot more states that it's not in, those 3 and a few more. But we're being told that it's coming, and it's coming soon, where it's going to be in all 50 states. So for now, I don't want you to go picking one of these, because if you call us and you're interested in this, we want to look at you and your conditions and where you live and see what's available to you. And we'll advise you of which one of these 2 would be right for you, or if one of these 2 would be right for you at all, because there's other options. So I want all these conditions here is during the last 3 years of offering these. These are real people. And with the case of Parkinson's, it's multiple people. With MS, it's multiple people that have these conditions, and they have this insurance in force right now because we were able to get them, pass them through. This company does a video underwriting. So they evaluate you, and that's a little intimidating to people. I mean, but what they want to do is they want to watch how you get around. You're going to sit up and down in a chair. You're going to walk toward the camera. You're going to turn around, walk back. I don't know, raise your hands. They want to see how you get about a room, how you can walk, how agile, how mobile you are. And then they're also going to do a memory test. And they're not going to ask you about your health, nor are they going to get your prescription history. So that's what they're using for underwriting. Parkinson's, MS, cirrhosis of the liver. I just know of one client. She looks fine when you look at her on interview. She does fine on the memory test, but she's got this. Rheumatoid arthritis, that's another one that they're going to observe. Is if you're in the late stages of that, maybe you won't get this because they'll be able to observe how that limits your mobility. But anything short of that, we have a number of these people. An aneurysm, lots of people with diabetes who their diabetes is outside the numbers that they'll take you, or the diabetes is with something else like a heart condition, where maybe they're going to be turned down for life long-term care insurance. We have a number of those people that just fly right through with this. Stroke, TIA, osteoporosis. That's another one that when they're doing the medical underwriting, they write to your doctor. They see your medicines. They have a question on the app. They're not going to take you on a life long-term care policy. This one, they don't even ask. And a lot of these people present very well in the video. Um, Now, moving over to this company does not do a video interview. I mean, this company is going to do just, we're just checking boxes. And so, Tom, if you could go in the show notes to their questionnaire, and I just want to call your attention to it, because if you want to go into this thing yourself and look at it about your particular condition, my suggestion is that you call us, and we have most of this stuff in our head, and we can kind of give you an idea of whether one of these things would be right for you. But if you look through here, the first 5 questions are yes, no questions. So in other words, if you got the stuff that's in the first 5 questions, you can't get this. But there's a lot of those people in those questions, they can get this. Okay. So that's going to push you back there. But one question that's not on this form of this company is cancer. And that covers a lot of territory and a lot of people. This company does not ask about cancer. So, if you've had cancer in your past, if you have cancer now, um, you can answer all the other questions in the top of the form. I mean, but I just gave a list of cancer, heart disease, chronic kidney disease, stroke, TIA. These are people, and I'm going to use the word probably, that you could have these things and still get this policy, and you're getting long-term care insurance. You're getting 3 times your money for long-term care. The people that actually get these policies, when they get approved, first of all, they can't believe it while we're doing it. Um, Obviously, we convince them, and they have enough trust that they place in us. And then when they get this, they're very, I mean, it's just, they're very relieved. And so this side, all the listing of stuff, like this company, if you have Social Security disability in the last 5 years, you can't get this company because they ask a question: have you had Social Security disability? This company doesn't ask that. So, so again, there's different reasons we would track you to a different one. I just want you to get the gist of things. If you've got health conditions, you want to check here if you want long-term care insurance. Tom?
Yeah, I mean, I think Hans makes a good point that each company of these asks slightly different questions, right? So it's not that you're comparing them side by side, and I like this one better than that one, right? There's sometimes you might be able to get one, you might not be able to get the other, or you might be able to get one that's not even on this board at all, right? We have a lot of other options that maybe are a little bit healthier than you think, and we might start there. So we have a lot of options available. The main reason we wanted to do the video today is that we have these ones specifically are taking people that you can qualify for it when maybe you've been told in the past, hey, we don't have anything available. You're too sick. You have this. No one's going to take you. That might not be true anymore. So maybe you've at one point have thought you couldn't get it, or someone has told you can't get it. There are now options, which is again wonderful, because ultimately this is some of the more important planning we do, because we've just seen the impact this has on family when there's not a plan in place, and it's devastating. And so you need to have a plan in place, whether it's this or something else, or just paying it out of your funds. You need to have thought through what happens when one of you gets sick, because at the end of the day, who ends up bearing the burden of that is your family, it's your kids, it's your loved ones, and they're not ready for that. And as much as you might think they are, no one is ready to put their life on hold to take care of a parent, to take care of a loved one in the way that needs to be done when you go through some type of care event like this. So I encourage everyone to come up with a plan. Insurance is a tool to use to pay for it. Not everyone needs insurance, but again, a lot of people I think should consider this that haven't done so in the past.
Okay, so I'm going to go back to the guy with Parkinson's, and I'm going to look 10 years out, okay, and just explain what all these numbers mean. His guaranteed cash value, of which he doesn't care too much about, 102,000, because he doesn't ever intend to cash this thing in. He intends to use it for long-term care. His projected cash value, if the market performs like it's performed over the last 10 years, anyhow, I don't want to get into all the, is 188,000. It's pretty significant. And his projected long-term care benefit is $454,000. His guaranteed long-term care benefit, $420. Not that much different. it's around $7,000 a month to $7,500 a month that he's going to have available for 60 months of long-term care benefit, where he's going to get, paid out in the 400 and some $1,000 department on his original $100,000. And he's thinking 10 years out, there's a pretty good probability that this is going to be started, given the fact he has Parkinson's. He's going to need help 10 years from now. Now, whether it's exactly there, right? The numbers look even better at 20 years. I want you to get that. If he's over on this product, the numbers look smaller, but he would be glad to have either one of these. Now, he couldn't buy this product because he's got Parkinson's, and Parkinson's is one of the no-no questions in their beginning ones. So, I just went through that one disease, so I really don't want people calling up and say, boy, I like product 2 better than product 1. I want you to put that on me. Well, there's a lot of hoops we got to jump through. If you have a serious health condition and you're able to get either one of these, you're going to be glad you have it. So, and we're going to direct you to the proper place. So I want to go over what, in terms of comprehensive finance, everybody that comes into us and does a plan, we talk to them about long-term care, unless they tell us not to. We discuss this on the front end. People come in. Long-term care is the third subject, the third worry, and we're going to address it, and we're going to make a recommendation within your plan to do something to prepare for long-term care. And this product, or one of these products, ends up in a lot of those recommendations. That doesn't mean that people have to buy it. It's just going to be in our recommendation. Now, we talked a little bit about IRA 401k, because you can't buy this with IRA money. So in other words, you're going to have to pull the money out of the IRA, pay the tax, and then put it in here, which is problematic. Now, what I will tell you is this company makes you start with 50 grand. So that you got to have 50 grand just to get the thing going, but they will allow additional deposits for up to 5 years. So if you wanted to get, say 150 grand in here, a lot of people buy these with more than 100,000. So you could start with 50. If you pulled the money out of your IRA, you pulled 70 or so out of your IRA, paid the tax, and you had 50 left to get one started, then you could spread the payments out over the next 5 years out of your IRA to put the net into this thing. So there's some ways, if you only have IRA money and you want to get one of these, that we can possibly work it out. So the IRA 401k, in terms of income, in our income planning, in our financial plans, we're going to put at the tail end of your life, both of you, or maybe even in your 70s with one of you, we're going to put, there's a gigantic need for income if a long-term care event happens, and that's where these things are positioned well to shoot out some very strong money for either 60 months or 72 months into your tax-free money. And then we've covered taxes to the extent that money coming out of, this is a tax qualified, both of these are tax qualified long-term care policies, so the money coming out for long-term care is tax-free. And then for estate planning, if you buy one of these things, live 10 years and then pass away, on this one, your heirs are going to get 126 grand back on your 100 grand. That's guaranteed. So there is a death benefit, providing it wasn't used for long-term care. And on this one, they're going to be a little worse off if the guaranteed happened for 10 years. They're going to be better off, your beneficiaries, based upon a projection that they'd have more money built up in there. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.